Hi, my name is Lloyd Danzig. I'm the founder and managing partner of Sharp Alpha Advisors. We are a venture capital firm that specializes in sports betting and online gaming. I view the explosion of the U.S. sports betting market as being, first of all, occurring amidst a backdrop of rapidly evolving user behaviors and consumer preferences, and as being part of a broader transformation in what I like to call competitive entertainment. Competitive entertainment is any type of entertainment where winning or succeeding is what matters and is where people get the material, if not the entirety of the utility derived from that activity. And so that includes playing sports, betting on sports, playing video games, betting on video games, casino, poker, horse racing, play-to-earn games, peer-to-peer games, skill-based games, certain forms of connected fitness, and things of that nature. And technology really is the infrastructure atop which all of these verticals are able to operate and serve their constituencies, and is the connective tissue through which these experiences can interact with one another and converge. And so what's most exciting to us at Sharp Alpha about the next few years in this industry is how technology is being leveraged to drive the next generation of competitive entertainment experiences. So in part, it depends what you mean by recent. As of the time of filming, the last 6 months have not been so kind to public companies in this space from a valuation and multiple perspective, whereas the previous 24 to 30 months did provide quite a favorable environment. That said, if we want to look at the period from the repeal of PASPA in May of 2018 till now in its totality, I think it has to be looked at as a resounding success for the industry in spite of any pullback in public company valuations. And that is largely attributable, first of all, to the flurry of public company listings that has put the sports betting sector or subsector front and center in the minds of mainstream retail and institutional investors, and coupling that with the commercial agreements signed by sports betting operators with professional sports teams and leagues and venues really has validated that sports betting is going to be inextricably interwoven into the fabric of the business of sports. It is going to be positioned primarily as an entertainment product, and that there are a lot of people who like to bet a considerable amount of money on sports, and so that at the very least, top-line revenues in the industry should continue to be quite significant. So in many ways, the sports betting industry is still in its infancy in the early innings. And to that end, in some ways, the next few years will mirror the past few, in particular in that there will be a continued gold rush for market access, for customer bases and databases, and for differentiated technology. I think the next few years will be a time in which we also see accelerated consolidation, some of which has already begun. And then I think the most pronounced difference in the next few years for this industry as opposed to the recent will be the shift in operator focus from customer acquisition to customer retention. And as we look forward, I think over the longer term, the story really starts to focus not just on retention, but on maximizing revenue and profitability on a per user basis. And most likely, and in fact, almost inevitably based on current trends and partnerships that we've already seen, that will involve something casinos and gaming companies have been very good at for quite some time, which is cross-selling their users into adjacent activities that are also revenue generating. But now that we're really in the digital world, that has sort of taken on a new dimension. And what we're seeing is a cross-pollination of sports betting with ticketing and merchandise and digital collectibles and NFT-enabled games, and a whole host of complementary, psychographically similar activities. And so we've started to see, to some extent, sports betting operators using M&A as the primary vehicle to acquire not just technology that is native to the industry, but technology that will allow them to cross-sell their users into adjacent and similar revenue streams. There definitely and clearly has been a pullback in public company valuations and significant multiple compression in the past 6 months in this industry. And it's often hard to separate to what extent that is driven by industry-specific factors versus macro factors. But the quick history seems to be that the run-up in public company valuations occurred during a period of hype and excitement and unprecedentedly accommodative monetary policy and consequently low interest rates. And that as soon as interest rates started rising and inflation fear started creeping in, and it became clear that the US was down a path of toward a period of tighter monetary policy, that investors really increased the level of scrutiny that they placed on customer acquisition spending in particular, and as a result seemed to have clarified or changed their position on how profitable they see sports betting's potential, which has in turn resulted in a sell-off and a pullback in public valuations. I think there are kind of two camps that investors fit into, at least the astute, knowledgeable institutional investors that I talk to seem to fit into one of two camps from a sentiment perspective. The first camp says that not only have sports betting companies proven themselves to be less profitable than originally was hoped, but that management teams have lost the trust of their investors by continually missing estimates and having to make continued downward revisions to forward guidance. Other camp two, says that the investors in camp one didn't really know what they were buying into when they first invested in the space, and that the customer acquisition spending dynamics in this industry have always been well known, that anyone who understands this industry well always knew there would be heavily front-loaded customer acquisition and market access spending, and that the majority of profitability would come on the tail end in subsequent years, and that the recent sell-off has been more than an overcorrection caused by people in the first camp selling their positions as a result of learning that maybe they didn't understand so much what they were investing in during the run-up. I find myself a bit between these two camps, and I think there's a bit of truth in both. But really, it's now incumbent upon a combination of the markets and of course, operators to see what profitability looks like as more states go live and as states that went live in 2018 and 2019 start to reach periods of maturity in which operators have been promising profitability.